Welcome to Master Wealth, your go-to channel for understanding the intricate world of finance. In today's video, we're unraveling the mystery behind interest rates, particularly focusing on how they impact your financial landscape. If you've been wondering about the recent interest rate hikes, the role of the Federal Reserve, and how it all ties into inflation, you're in the right place. By the end of this video, you'll not only have a comprehensive grasp of interest rates, but also insights into what the future may hold. Stick around and you'll be better equipped to make informed financial decisions. But before we dive in, if you're finding this information valuable, don't forget to subscribe to Master Wealth. Stay updated with our latest insights and strategies for mastering your wealth-building journey. Now, let's get started. Demystifying interest rates. Our financial journey begins by demystifying the term interest rates. To clarify, we're not referring to the interest rate on your mortgage or credit card, but rather to a broader concept known as the federal funds rate. The federal funds rate is a crucial financial thermometer set by the Federal Reserve Bank in the United States. Think of it as the wholesale price at which banks borrow money from each other. When this rate rises, it sends ripples through the entire economy. Just like a hike in wholesale costs can lead to higher retail prices in your everyday life. When the Federal Reserve Bank raises interest rates, it exerts upward pressure on consumer interest rates. This includes rates on mortgages, car loans, and credit cards, as banks need to pay more to borrow money from one another. The historical trajectory of interest rates. Now, let's take a historical journey through the world of interest rates. A crucial point to remember is that the Federal Reserve Bank uses interest rates as a means to control the economy. When things are getting too heated and inflation is on the rise, they raise interest rates to cool down spending. Conversely, when a slowdown or recession looms, they reduce interest rates to stimulate the economy. Here's a quick look at the federal funds rate history. Early 2000s, rates rose to about 6.5%, but a recession and the aftermath of the dot-com crash prompted a rate cut. 2008, the financial crisis saw rates dropping to nearly 0%. 2009 to 2016, rates remained near zero to spur economic recovery. 2016 to 2019, rates began to rise. 2020, the pandemic hit, and rates fell back to zero. 2022, interest rates started to rise again, and this time faster than we've seen before. This historical context shows how interest rates function as a tool to manipulate economic conditions. Inflation as the central player. Inflation has become the central player in the interest rate saga. Let's dissect the recent inflation trends and the Federal Reserve's inflation target. Understanding these dynamics is essential in gauging where interest rates are headed. 2020, the pandemic caused some prices to fall. Inflation typically increases coming out of downturns as demand outpaces supply early in the recovery. But this tendency has been exacerbated by COVID-19 impacts. Demand for many goods dropped in 2020 and remained lower in 2021 as further waves of COVID cases led to government restrictions on consumer behavior. 2021, inflation skyrocketed to 7%. 2022, inflation was around 6.5%. 2023, as of September, inflation is approximately 5.3%. The Federal Reserve Bank's ideal inflation target is 2%, particularly in terms of core inflation. This is the inflation rate that the Fed monitors closely. The dilemma arises when inflation proves challenging to bring down to that 2% target. In such a scenario, the Fed might be compelled to maintain or even raise interest rates. This balanced act is driven by the need to keep both inflation and the economy in check. The X factor, the economy versus inflation. Now, let's explore the X factor, the economy. If a slowdown or recession looms while inflation remains high, the Federal Reserve Bank faces a challenging decision. High interest rates cool down the economy, while low rates stimulate it. To deal with the recession caused by inflation, you can't use more inflation as the remedy. This delicate balance can impact your personal finances significantly. This is why we've been emphasizing the importance of financial education. The financially educated tend to benefit from inflation, while those without financial knowledge may suffer its adverse effects. What lies ahead in 2023 and beyond? As we look ahead to 2024 and beyond, here's what you need to consider. With interest rates already on the rise, you might want to think twice before financing that new truck. Instead, focus on building financial preparedness. Create a savings cushion to safeguard your financial stability and to capitalize on opportunities when they arise. Don't forget to enhance your financial education. Understanding the current economic landscape and investment strategies is crucial. Being a financially informed investor will put you in a position to make the right moves in a complex financial world. Interest rates and investment strategies. Interest rates play a pivotal role in shaping investment strategies. When interest rates rise, it can affect the prices of various asset classes. Let's explore how different types of investments are influenced by interest rate movements. Bonds. Bonds have an inverse relationship with interest rates. When rates rise, the value of existing bonds falls. Investors may demand higher yields from new bonds, which impacts bond prices. If you're holding bonds, especially long-term bonds, rising interest rates can lead to capital losses. Stocks. The stock market's reaction to interest rates is more nuanced. Initially, rising rates can lead to stock price declines as higher yields make bonds more attractive. However, if rate hikes are driven by a strong economy, corporate earnings may improve, ultimately benefiting stocks. Real estate. Real estate is particularly sensitive to interest rates, especially the housing market. Higher mortgage rates can deter home buyers and impact home prices. On the flip side, real estate investment trusts, REITs, can be affected by interest rate changes. Economic sectors and interest rates. Interest rates have varying effects on different sectors of the economy. Understanding these dynamics can help you anticipate how interest rate changes might impact your career or business. Let's explore how interest rates influence different sectors. Housing. As we've stated before, the housing market is profoundly affected by interest rates. When rates are low, it becomes more affordable to buy a home, boosting demand. Conversely, rising rates can lead to decreased home sales and potentially lower home prices. Automotive. The automotive industry, much like housing, experiences fluctuations based on interest rates. Lower rates often lead to increased car sales as financing becomes cheaper. Conversely, higher rates can slow down car purchases. Finance and banking. Banks are directly affected by interest rate fluctuations. When rates rise, banks can charge more for loans, potentially boosting their profitability. On the other hand, lower rates can reduce their profit margins. Consumer goods. Interest rates plays a role in consumer spending habits. When rates are high, borrowing becomes more expensive and consumers may cut back on spending. Lower rates can encourage consumer spending. Navigating your personal finances. Your personal finances are not immune to the effects of interest rates. To make the most of your financial situation, you should consider how to adjust and thrive in different rate environments. Savings and investments. Depending on your goals and risk tolerance, you may need to adjust your savings and investment strategies. In a rising rate environment, you might lean toward shorter-term, lower-risk investments. Conversely, in a declining rate environment, you might seek higher-yielding assets. Debt management. Managing your debt is vital. If you have variable rate loans, be prepared for potential increases in your monthly payments as interest rates rise. It might be wise to refinance to lock in lower rates. Emergency fund. Having an emergency fund is essential to navigate financial uncertainties. It provides a financial cushion that can help you withstand interest rate hikes or unexpected expenses. Global impact of interest rates. The effects of interest rates are not confined to national borders. In our interconnected world, global economies are influenced by interest rate movements. Here's how interest rates can ripple through the international landscape. Foreign exchange. Interest rate differentials between countries can influence foreign exchange rates. Higher rates in one country can attract foreign capital, potentially strengthening that country's currency. Trade flows. Changes in interest rates can impact international trade. For instance, a country with high rates may experience an influx of foreign investments and increased demand for its currency, potentially affecting its trade balance. Global investments. If you have a globally diversified investment portfolio, you need to consider how interest rate changes in various countries can affect your returns. Some international markets may respond differently to interest rate movements. In conclusion, interest rates are a fundamental element of our financial landscape. Their influence reaches every corner of our financial lives, from mortgages to savings accounts, investments to the job market. By grasping the dynamics of interest rates, you can better prepare yourself for the twists and turns of the financial world. So, whether you're an aspiring investor, a homeowner, or someone aiming to take control of your finances, remember that understanding interest rates is a valuable tool in your financial toolbox. So, where do interest rates stand now? 5.3% as of September's numbers. Will they continue to rise, or will an economic slowdown change the course? It's a question that remains to be answered. However, the Federal Reserve has stated that interest rates will continue to be elevated until 2026. With the insights gained from this video and your commitment to financial education, you'll be well prepared to navigate these uncertainties and the market along with it. Thank you for joining us on Master Wealth, where we simplify the complexities of the financial world to help you master your wealth building journey. If you found this video valuable, please give it a thumbs up and subscribe for more insightful content. Your financial success is our mission, and we look forward to guiding you in your pursuit of mastering wealth. Remember, your financial journey is in your hands. Keep learning, stay informed, and master your path to wealth. Cheers!